Thank you, Dave, and good morning, everybody. Thrilled to kick off this Festival of Traders event. And we like focus at Big Trends. It's always about how can you zero in on a particular edge. And for me, there's no better way to get focus than to focus on just one simple security, right? Not trying to scan across hundreds of different names. Which one should I trade? That creates a lot of stress. It creates a lot of work. I don't think that you have to stress or work that hard. I think you can focus on the leaders. And one of the best leaders, a lot of people talk about NVIDIA or Apple or Microsoft, but Palantir, PLTR, it's kind of become the stealth new leader in terms of that it's been like the best performer in the S&P 500 last year. It's continued to perform. What is Palantir? It's basically a way that a company that's taking advantage of AI in all kinds of new ways, including getting big contracts with the Department of Defense and basically Department of Defense making up a healthy percent of their revenue. And you say, okay, is the Department of Defense going to shrink? Probably not with the Middle Eastern worries and worldwide geopolitical worries, Russia, whatever you want to throw out there, Ukraine and whatnot, loads of different things happening and likely to continue to be reasons why we have to stay at the cutting edge thanks to companies like Palantir. So I'm going to walk you through how we trade options on Palantir and how you can trade options on it and take advantage of the strategy as well. As I get it rolling, just a reminder, the information that I share with you in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. It should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but they also have large potential risk. We'll talk about how we manage both sides of the coin here today. And remember, even when we talk about past performance, that the past performance of any trading system or method is not necessarily indicative of future results. Do see our terms of use on our BigTrends.com homepage. So it's all about leverage and it's all about focus here, laser focus, just focusing on Palantir, tickers PLTR, of course. And the goal is to say we can get even more bang for our buck on a leader trading options on it. So walk you through a bunch of the success stories as we've traded Palantir calls and occasional puts. Frankly, it's been such a leader that more of the action's been on the upside. But when these leaders get smacked, they can get smacked pretty hard and fast, like you saw in April. Palantir came down pretty fast, and there's some bear opportunity out there from time to time as well. But you got to pick your spots like we do to not be holding bearish positions for too long. This is quick strike swing trading here, so I'll walk you through this, and you can get more details how you can start getting these Palantir options trader trades as early as this afternoon. Now, I've been trading for now 36 years and counting in stocks and options. I got the trading bug when I was a student at Duke University, and basically saw that trading was kind of the ideal business when it came to liquidity, getting in and getting out easily. So most everything that we trade at Big Trends, I launched Big Trends more than 25 years ago, is based on active liquid names, things that we can get in and out easily. It's not like a Roach Motel where you can get in but you can't get out. That's important to not trade names that just trade by appointment, especially in the options market. So we need most active options favorites, and that's where Palantir comes in to become a really popular optionable stock. So of course I've been blessed to be featured on Barron's CNBC, and it's always about a systematic approach for what we do. Also blessed to be inducted into the Traders Hall of Fame back in 2007, joining a lot of my trading heroes. My wife said I needed to get a hobby when I was just getting in a trading game. I was married pretty early, and basically she's like, "Don't you do anything else with the stock market and the options market?" I said, "No, I love this stuff. I eat, sleep, breathe it," and so it came from a lot of great education. My goal is to keep educating you and fellow traders on things that have worked for me that can work for you too. So that's what our goal is today. And this is kind of unique in that a lot of people have option services where they got a whole bunch of different names out there. We're just focusing on one leader here. And you say, why should you care? Well, what we're going for here is something that can at least double. And then if it doubles, we want to sell half of our trade. That there's nothing better to me than getting into a proverbial free trade position. When you double half of your money, you take half of that off, and now you've gotten your risk capital back. Getting your risk capital back, we all have this bias, this cognitive bias in our minds about like where this position is relative to where you bought it, where I bought it, where somebody else bought it, right? And we could have bought it at different levels, and that creates all kinds of different feelings about where Palantir is relative to where we bought it, right? But does Palantir care? Does the stock market care? Does Palantir trading market care? No. It's basically all about staying flexible and really kind of releasing yourself from that bias of where you bought it. And when you can release yourself from that fear of loss, right? That's one of the fundamental fears, right? In the trading markets is fear of loss. There's another big fear on fear of missing out, right? The key is that we can't worry about where Palantir was a month ago, a year ago, 3 years ago. We worry and look at where it is now and where it's likely headed in the coming week. Okay, we're looking at a 5-day maximum hold here. So we will not hold it longer than 5 trading days. We've had a number of trades that have gone after doubling, and you free yourself up to let the rest of the trade run for 5 days. When you're really on a tear, I don't know about you, but my experience in 3.5 decades, 35 years plus of options trading is that when you're right, you tend to be right longer than you expect. And by the way, when you're wrong, and when I'm wrong, I tend to be wrong longer than I expect, right? So it's like getting rid of things that aren't working quickly and then letting your winners run, at least on part of your position, once you free yourself up financially and psychologically from that worry about letting your profit slip away. So we've had some that have gone up on 600, 800%. We say if it gets to 1,000%, we'll take it out early, but usually the 5-day rule allow us to get well over a double on the remainder of our position. And even if it doesn't, we can still lock in some healthy gains. So let's look at some charts and some trade examples, and I'll go into more detail about how the Palantir options trader strategy works. Most of the stuff that I do in terms of different trading systems is keyed on daily charts or hourly charts. This is even a little faster. This is looking at 30-minute charts. So we're actually wanting to adapt a little bit quicker here. And the main indicator we're using is the Larry Williams %R, percent range indicator. Sometimes on some platforms you'll see it listed as Williams %R. I know Larry, he's a great trader and a great person and has been a true trading innovator. I use a different scale than Larry, though. I like the grade school scale, 0 to plus 100. And so we kind of divide the %R into 3 zones, the bottom third, the middle third, and the top third. And you'll see some different kind of patterns and behaviors on that. And then we use it in conjunction with the bottom indicator, which is the ADX there in that pink line, where we say, okay, if we've had a downtrend, we're in the bottom third of the %R readings. And let me explain, first of all, what does %R mean? It means, okay, where has the stock been when you mark its recent highs and its recent lows? And we actually use a different length of %R than most people, a little longer setting, so that we can actually see the bigger picture moves and trends that are developing. But we've been in a downtrend, obviously, on this first part of the graph here. And so when you've been in a downtrend, and of course, when ADX is going up, that means that the trend was working to the downside. But when ADX rolls over here, and we're coming out of the bottom third of readings, you can see we move out above that bottom third reading. That's a pretty good sign to say that the bottom is likely in. Now, it may not be instantaneous in how fast it goes up. This one got going pretty quick, then kind of retraced. You can see we had kind of the first leg rally, but then we also had the retracement back down. We say, well, that actually initially hasn't made that much progress after a couple of days, even though we got that first gap. We didn't get a chance to double our option, so we're still holding our full position until it rips back up again on this basically third wave up. If you had the first wave up, second wave down, third wave back up. So stock has rallied from, you see, it started out about $76. Notice what we bought. We bought the 86 strike calls. And you say, well, how far out will you buy before expiration? We'll typically give ourselves out to the following Friday's expiration, because we know that if we bought it on a Monday, we're going to hold it to the following Friday. It gives us almost 10 trading days to work with, 9.5 trading days to work with here. And so we're really looking for a situation where we can give this a chance to run over those 5 days and be out by the following Monday afternoon. If we bought it on a Monday, we're going to be out by the next Monday. So you can see what we're doing here is we get the first target when our 268 that we invested per contract, $268 to control each 100 shares. 100 shares would cost you $7,600, right? So you're getting about 30 to 1 theoretical leverage here. And you're saying, okay, we want to sell half our position. Well, we only got 3 contracts. If you're putting $1,000 in for, say, a starter type of a test account, that's typically what a lot of our subscribers would start with. So we're not showing you the maximum, but rather what we'd recommend is kind of a minimum level that you might want to start with, but you can decide what's appropriate for you. But you say, okay, if I was going to put in $1,000, I could only get 3 contracts. The fourth one would put me over 1,000. 268 times 3 puts me in for a little over 800 bucks, right? And so we're saying, okay, we get in for about 800 bucks worth, and we get our double, and we on an odd number of contracts we sell one more than half of the contracts, so we can't trade 1.5 contracts out. So you got to sell 2 of those contracts at 536. You're already taking down a guaranteed profit at that point because you're getting $1,072 back versus your 800 or so you put in on the front end. So even if the other contract went to zero, went to nothing, you would still make money on the trade, right? That's a very freeing feeling. So when we get this pullback after we've gotten the first target 1 here would be the double, then we do go through a little retracement. We do go through some basically flattening or flagging behavior, right? We're just kind of stuck in this flag pattern sideways, basing out, right? Then it gaps up, and we're saying that's our last day, that following Monday, that we could hold this trade. Even though it won't expire until that Friday, we get out typically in the last hour of the trading day. Stock's up to 93, right? It's gone from 76 to 93. Our last part of our position is sold at 207%, $8.25, 825 bucks on that last contract collected versus the 268 bucks you got. You're taking down another, 460 bucks or so on that final contract. Overall, the trade generated, you can see $1,093 in total profit for about a week's hold, right? So the idea is, okay, the stock went from 76 to 93. So the stock went up, as you can see, about maybe 16 points or something in the neighborhood of almost 20%. And we're averaging out at about 150% across the 2 different targets, right? But the idea is that that second target will be flexible. It's more of a time-based, give it a chance to run. But the pattern you'll notice, and this is a pattern that I've noticed for a long time now and taught for a long time, is that the top third of readings is sometimes where you get your biggest uptrends. And that's so against the common wisdom that people say if something's quote unquote overbought, you should probably get rid of it. And some people try to bet against it. In my opinion, it's a huge mistake. You can see it was just starting to surge, and it was basically, even while it paused, it was still getting ready for its next leg up. That was a pause that refreshed the stock and allowed it to get some catch its wind, catch its breath, right, and basically get ready to rally again, right? So some of our basic strategy guidelines are that we don't want to hold it more than 5 trading days or 1 full week. The strategy here is we're going to use that percent R across the different thirds, and we'll talk more about some bullish strategies when it gets into that top third as well. We're not fading that quote unquote overbought market until maybe it sometimes gets really super extended. But we use it in conjunction with the ADX. That's the average directional movement. Now, you don't have to know all this stuff. We call out the trades for you in real time, so you don't have to sweat it. But the point is, so we send out real-time email alerts, and you can also get text alerts when to get in, when to get out on each and every trade. We never leave you hanging going out to the next Friday's expiration. So if we had a signal today, we would be going into the next Friday, and that would still be fine because we'd be out by next Thursday, a day before the expiration. The 30-minute chart gives us a little more speed. Now, we only have a few trigger points where we can get into a new trade, and it's at 10, 10:30, 11, right? So if we're past 11 right now, then we would say we'd wait till tomorrow for a new setup. So we're looking for something where there's some catalyst, there's some movement kicking right off of the open in the first hour to hour and a half of the trading day, right? And so what we're doing is we're saying we're trying to minimize the noise. We're not going to be able to eliminate all of it, but we're trying to minimize it to give us the true trend and let the true trend be our best friend, right? In options buying, a lot of people assume, okay, well, options buying, that involves time risk. And that's true. You know, you're paying for time, you're paying for volatility. You need to get a reasonable speed of movement in your underlying stock to offset that loss of time, right? So that's why our system is designed to say, what are the sweet spot phases where we think we can get more trend direction and basically more than pay for that time with extra leverage that the stock makes, like that 20% move I just showed you in a week, right? I mean, that annualizes out at like 1,000% annualized if you do 20% in a week, right? So the idea is, okay, you know, not all of them are going to do that. We're going to have winners, we're going to have losers, but the idea is we want that type of annualized speed of movement working for us and for our Palantir options traders. We have plenty of trade opportunities, plenty of profit potential, and then we still have to manage our risk, right? So we're going to talk about that too. The key, though, is that you said next week options, that's pretty close to expiration. Well, a lot of the common educational sites on options and the exchange sites and stuff will tell you never buy an option under 30 days. That's because they're worried about people that are going to do dumb things and hold them all the way to expiration and get themselves in a position where they end up with big losses, right? We want to take that off the table. So we've got a couple of rules to do that. One of the rules is buying the next Friday's expiration, being out typically at least a day before the expiration. 5 trading days. We'll exit around 3 p.m. Eastern, the final hour of the trading day, if we haven't already gotten targets achieved or a stop hit, right? Our average contract entry price since the beginning of last year was only 82 cents. I mean, an average of 82 bucks to control each 100 shares of Palantir. That cost has gone up a little bit in recent times because the stock has rallied. Like Palantir right now trading at 140 and a third. So it's going to cost us a little bit more than that typically because of the higher price of the stock compared to a year ago when it was trading at 40 or 50 bucks, right? So, but still, we want to keep our contract price down, and we're going to buy out of the money options to help do that, right? So that's why we have to have these risk management tools in place to say we're targeting a double. We're going to take a 50% stop if it gets hit. So we know that that's part of our risk management too, right? We've got to have a plan to say if it's not working, we don't want to ride it out to a total wipeout. So that's important to manage that risk. So let's look at the overall performance though. And again, remember when we look at performance in the past, we got to remind you past performance will never guarantee future results. Future results are going to vary. They could be worse than this. They could be better than this, in this past year and a half or so, right? This is going back to the beginning of last year through today on all closed trades. So a $5,000 model portfolio grew to over $30,000. That's before commissions, before subscription investment. That'd be more than a 6-bagger gross. And that's with no additional compounding of your original investment, right? We're saying if you allocate $1,000 a trade at the start and even on the next trade, you'll still be allocating only $1,000 a trade with no compounding. So of course, on a $30,000 portfolio, that would mean like 3 1/3% maximum commitment per trade of your portfolio. So actually it's reducing your risk as a portfolio grows on each individual position as a percentage of your portfolio. So that's important. And so 5,000 over 30,000. And the key is that it's focusing on the speed of movement concept. Remembering that past performance will never guarantee future results. There's going to be ups, there's going to be downs. You need to make sure you're trading an amount that you're comfortable that you can have a loss or two and not sweat it. That you can keep on executing and looking for that next winner to more than offset it, right? So that's part of the objective. So like I said, we break that percent R, that's a Williams percent range indicator, into thirds. So if we're in the top third of that recent range or the bottom third of that range, those are actually potentially bullish zones for us, depending on how ADX is shaping up. That's the average directional movement. We can get bearish signals if the percent R gets too extended into the top 10% of readings with the right confirmation of the ADX. So I don't give away the exact settings here for free, but when you become a subscriber, we give all the settings to all paid subscribers, so you can actually learn how to do this. We just ask you don't share it with anybody else. It's for you and your family's benefit. And so that's part of our terms of service. Keep it for your own benefit on this intellectual property. So here's a classic example of a top third big trend to the upside, right? And you see the first 30 minutes of that trading day. This is looking back here on a Tuesday morning when Palantir was gapping from, it had been down in the mid 40s and it gaps, and by the end of that first half hour closes up here at about 50 bucks. So you say, man, it's moved up like already 10% in the first 30 minutes of the trading day. A lot of people say, oh, I don't want to chase it. I might feel foolish if it comes back. That's usually a mistake. It's usually it's gapping up for a reason. Whether it's earnings, whether it's a brokerage upgrade, whether it's some product related news, whatever the driver is, remember, the market is driven by institutions. The institutions are just like you and me as individuals. They want more of a good thing. If the news is good, they're going to keep plowing into it. The advantage you and I have as individual traders compared to the institutions is we can get our position on in full all at once real quickly and real easily. If you're a big institution trying to buy millions of shares of Palantir, you're kind of like the 800-pound gorilla in the baby pool. You don't want to jump in, splash all the water out of the pool, right? They tend to tiptoe in. So they have to gradually build their position. I believe that's why these trends tend to last and persist longer than you and I would expect, right? So we were recommending there on our system says buy Palantir 52 strike calls at an average entry price of $1.08. So that's $108 to control each 100 shares of stock that would have cost you about $5,000. right? So you're getting plenty of leverage for like 2% of the cost of the stock, right? So the idea here is that you know, $1,000 invested, you could buy 9 contracts, $108 a piece. That's $972 into the trade. When it doubles the next morning, you know, see, it's just kind of steadily trending up. The next morning, it does gap up again, gapping up here to about 53, 53 and a half. So the stock's rallied maybe 7% at target 1, and we're making 121% on that next morning gap. So you can see the leverage potential in the options is pretty significant here, something approaching about maybe what, 16 to 1, 17 to 1, something like that. But the idea is that, okay, we're selling 5 of those 9 contracts, and then we're saying the next 4 contracts will be held per the 5-day rule, right? Give it time, give it a chance. And isn't it phenomenal to say, well, how is it a percent R or percent range can stay in the top 10% of readings for such a long time and you can stay with the trade? Well, notice the ADX down below. The ADX keeps on trending up, right? So ADX only peaks out right in this area. So if you're just an ADX follower, you probably would have been out a little bit earlier. Our system says you should hold it for the full 5 days because you're in a risk-free position. Sometimes ADX will be a fake out and then it will pop back up. And there's enough of those in our data that say that, okay, we don't get out just on an ADX rollover once we're in a risk-free position in the trade, right? You've sold half or more of your contracts to get all of your risk money back in your account in the safety of cash. And now you're just riding the remaining 4 contracts. Some people call that the market's money on the free trade idea. I never have said that. It's still your money, right? You still want to manage it intelligently, but at the same time, you want to give it a chance to run, right? You bought the following Friday's expiration. You know you're going to be out by that Tuesday afternoon. That with a few more trading days to go before the expiration, even if the thing just flattened out from our first target. Still have something to salvage. As it turns out, the stock rallies all the way to 62. By the time we're getting out, it's closer to about, you can see maybe 59 and a half. Remember, you got a 52 strike call. We're getting out at $7.80. Maybe it's $7.50 intrinsic, and then maybe another 30 cents a time, right? But a lot of the time is getting extracted at the point it goes deeper in the money. And yet that's fine with us because it's moving more point for point with the stock, and we make 622% on those last 4 contracts. Thought of another way, those last 4 contracts made you each $672 a piece times 4, more than $2,500 on just the last 4 contracts. In fact, you can see the last 4 make up the bulk of your $3,300-ish profit on this trade, right? Your maximum commissions should be no more than $1 a side or $9 in, $9 out, total $18. So you keep the vast majority of what you make. Never a better time in my 35 years of options trading to be an options trader than now. Okay, I love how you can basically do this work and not have commissions eat into your profits in any meaningful way. So point is that, okay, not all of them are going to keep going to that kind of monster 600% or more return. Sometimes they'll even make a second half loss. You know, this is one of those where Palantir had earnings. And the only time I really love to hold a position into earnings is if we can free roll, if we've got a free trade. If you say, okay, even if it tanks, I still can't lose on the trade. And that's what happened here, right? We had our very bullish signal happening with Palantir. We're into the 84 strike calls when the stock's about 78. So it's still about, what, 8% out of the money. We're buying 12 contracts for just 83 cents a piece, right? And so that's getting us in for like $996, almost our full $1,000 commitment in the trade. When it pops up to about 82, notice it doesn't even have to go to the strike price. It goes up about 4 points into that next trading day, and we're selling half of our trade at the double. That's before earnings. You get yourself to a risk-free position. You see, it turns out we sell it near that top, right? And then the earnings hit, and you think, well, Palantir earnings should be great here, right? Big E on this, a big initial gap down, right? So guess what? Okay, we're sitting on something that's not looking so pretty. And you see, even as it rips back up into the Thursday afternoon, there's only 1 trading day left. It's back to $81, but it's still 3 points out of the money with 1 day left. We're getting out per our rules and get $26 a contract on the last 6 contracts. That's basically our profit when you got a free trade on the first piece. So you made sure you're not going to lose, but you really haven't won yet either. You just sell exactly half at a double. But you're saying, okay, the second half lost 68% and we still made $156 on the trade. So nothing to brag about, but it does show you that, okay, when you play into earnings, sometimes you get the huge gap in your favor and you can make many multiples of 100%. Other times you can lose the full 100 or close to it. We lost about 2/3 of our money on the second half of the position, yet we still, because of having taken half off at a double, made money on the trade, right? That's how you turn turn losers into winners. Not big winners, but that's how you get away from the volatility that most people have experienced as an options buyer and say, taking partials at the double gives you the opportunity to keep riding, but also takes the stress out if it doesn't keep going, if it goes the other way. We expect to generate about 6 to 8 new option trades on Palantir each and every month. Now, sometimes we'll get back-to-back trades that can win here, right? So here's one. Again, you notice some of our best patterns are where percent R goes in the top third. That seems so counterintuitive, doesn't it? But it's percent R implies that it's a range, when in fact you see that there's no range happening here. It's a steady uptrend in retrospect, right? And so why does percent R stay so strong? Because it's losing the old lower price data and it's picking up the new higher price data. And so it basically keeps pushing that theoretical top of the range because the range is actually expanding. What does expanding range mean? It means higher highs and higher lows. That indeed means an uptrend. Okay, so it's kind of a misnomer in that way. I often joke and call percent R percent T in these phases, percent trend instead of percent range, right? Because we're in the trend phase in the top third of the readings here. You can see we get our first signal, and you can see that we're going to get target one hit when we get 177, 5 contracts. 3 of those 5 sold at target 1, and then the other 2 sold 5 days later at target 2, which is the time stop, right? 5 days later is our remaining 2 contracts, actually, 735 a piece. That's a 315% gain on the second piece of the position, a 4-bagger. And that's just the first trade. One of our rules, and this is the key to leveraging when you're right, is if you can take half your capital off and get to a risk-free trade on the first position you put on and you get a new signal, we consider that you can take a second overlapping signal on your, if you have half of your position left, if you've taken your risk capital off of the first half. If you hadn't taken the risk capital off, we would not take a new trade. But if you've gotten your risk capital back, you can see after that trade generated $1,650 in profits, we do get a new signal actually right after we get our first target. You can see it hits here on just 2 30-minute bars later on that Friday morning. So I'll call that point A for the second trade in that chart, same chart. And so point A is where we're getting into the 118 strike calls. Now, of course, that's on a Friday. So we're going on to the next Friday. So you see that we're buying 118s when the stock's about 109. And you can see paying $1.53, right? So it gets to 6 contracts. And so you can see here that as we go and look at, say, A1, which will be our first target on that A entry, that you say, okay, that's our first target. Stock's gone up about to the strike price, right, to 118. So our 153 is turning into 306. We're taking the double on 3 of our 6 contracts. And then, of course, we've got 3 left. And so those last 3, you can see, give it the 5-day rule, and that's where it goes from 118 to 124. And you can see it, and it still has some time remaining here. We end up getting 1170, and you can see that makes 664%. $3,500, even a bigger profit. So that was important, right? If we had passed on that second trade because you're like, oh, I already have half of a position on, well, that's a risk-free half, right? So we want to basically keep adding appropriate risk if you can get to risk-free positions, and then you basically essentially have 1.5 positions on from that first entry on that second trade to where you get that next final target on your original position. So point being that we can layer additional trades on top if you get to risk-free positions. How do puts work? They're rarer, they're not going to happen as frequently, but we look for a pattern where we've got percent R in the top 10% of readings, and that's not the rule, right? That alone is not enough. And you're getting this ADX having been trending up, now rolling over to suggest a reversal is hitting, right? So at that point, at the close of that 30-minute interval, we're trading just over 96. We're buying an 87 strike put. And so you can see here that we're buying those for $1.32 a piece. That would get you 7 contracts in for like $924 total. Okay, couldn't get that 8th contract, that would push you over 1,000. So if you got 7, you're targeting 4 at the double. You can see that happens just a couple days later, from a Tuesday morning to a Thursday morning when the stocks popped from over 96 down to about 90, right? So we're getting a nice little quick pop on the downside that gets you the chance to get to a risk-free position. And then you see it bounces back right after we get out, where it's back to not that much of a gain on the second piece, the last three contracts for that little bounce there. But you see that's still just going through that process. We still use the 5-day rule. Stock tanks all the way down on that following Monday morning to about 78.5. But our rule says give it a chance to go for the full 5 days to the Tuesday afternoon exit, which ends up being closer to 82. We've got an 87 put that's worth at least $5 intrinsically. There's a little time left. We get 545. That's 312%, and you take down $1,767 gross, minus about $14 in commissions, about $1,750 overall for just $924 invested, right? So that's the composite approach to let even a bearish trade keep running for the 5 days when you catch it right. But let's face it, sometimes we don't catch it right. Sometimes we get stopped, and sometimes that's just the nature of the beast. This looked like it was still checking our boxes. We got our breakout entry. We got our ADX running to the upside. We get in here as we kick off this little breakout gap, and it holds. We get in about $94 on that 30-minute chart. We're buying the 102 strike calls. And after being wrong initially down to 91, that doesn't panic us too much. We don't get stopped out down 50% yet. Maybe we're down 25% or so in that next couple hours. That happens. But then it rips back up to 99. You're thinking, hey, I'm sitting pretty. It should give me a chance to double. Well, it only went up to about 50% gain, unfortunately. And so then when it did rip down, we've lost from a Monday morning entry to a midday Wednesday. It's now going the wrong direction. We're getting stopped out 51% loss, right? So that's going to happen from time to time. It's part of the game, right? I still say if I can risk 50% or so versus make 100% or much more, that's still a good risk reward ratio. Even if we can do it where we don't even have to be right half the time. Even though if you're right half the time at a double, you're wrong half the time, down 50%. That still stacks up as a positive expectancy. Of course, that big other bonus is having the chance to turn the other remaining part of your winner into a 200, 300, 500% gain or more. Sometimes, rarely, but again, those can carry you. It doesn't take a lot of those to make it real effective. Here's an example of one of those bigger winners. Started with just a $71 a contract entry price, went up to $525. This is on a Palantir 59 strike call, and you can see this is a great example where if I was just following the chart, I would have stopped out of the second part of the trade before the big winner. But you see, the key is that the time rule really helped us here. The chart said, yes, we've got a super strong buy, the ADX trending up. That's an entry for the bull side right there. And we're trading about $57. We're buying the 59 calls. So we buy 14 contracts at $71 a piece. So the next morning, it's already up to about 60 to 60 and a half. And so we're actually getting out of the half of our contracts at better than the double, 138%. So you've guaranteed yourself a winning trade because you're getting 7 contracts out for about in the neighborhood of about $1,100 or so when you only put in less than 1,000. So, but the key here is that you can see that we still got 7 left. And if I was just looking at something like the percent R, looking at the ADX rollovers, here's a great example where the ADX rollover would tell you, get out in here, put a question mark on it. Should I have gotten out there? Maybe in the short term, that might have looked smart for a couple or 3 days because it does kind of get a little choppy here. If you just use the percent R coming back under the bottom third, it would have gotten you out right near that short-term low. We said hold it for the 5-day rule. Instead of getting out at 59 or 60, we're getting out at 64. And look at the difference that makes on your profit. The second half of your position, 7 contracts are exited at 525 for 639% profit, right? So instead of getting out of the other piece at basically less than 100% gained, we get 639%. That's the aha that says it doesn't take many of those to say it's worth taking off the trailing stops on the second half of your position and just giving it the 5 days. Even if, like I showed you an example where it lost, right? It's still worth it because if you took it out at even 100% in the second half and you could have made 600%, that 500 percentage points extra is a big difference in your total return, not just for the trade, but for your month and your year, right? I mean, so, if you're trading a small account and you say, well, those last 7 contracts, instead of doubling, they make you that extra, like, an extra $400 or so a contract. You say, okay, well, that's times 7. That's an extra 2,800 bucks they might not have had, right? So we end up taking down 3,864 bucks on the trade, and a bulk of it driven by the last half being such a bigger winner. So the key is that's to me what will pull you forward as it's a growth strategy for sure, but it's definitely one that says that's why it's worth holding it for the 5 days. So sure, trading next week options, this is not for widows and orphans, so I acknowledge that. But the idea is that, okay, I've only got a few more minutes, so I want to just kind of remind you kind of like how powerful the strategy is, and basically how you should be taking advantage of this. Everybody's talking about NVIDIA, Microsoft, Apple. A lot of people are missing Palantir. You need it into your portfolio. And to me, this is a perfect way to do it with a focus approach. 5,000 went to 30,000, reminding ourselves that past performance never guarantees future results. The beauty is we didn't leverage up the amount invested per trade. We didn't scale it up. We kept it at a maximum of 1,000. So that's actually a more conservative way to show it. And that's over just a year and a half, sixfold in a year and a half. The future will vary. It may be better or worse than that in the next year and a half or so. But the idea is that what will not vary is our consistency to get you real-time trade alerts, when to get in, and more importantly, always knowing when to get out. We never leave you hanging. So what we've got for you here today is what we call Palantir Options Trader Special Try It Out bonus, get started. Basically making it as attractive as I possibly can to get you started, right? Giving you as little barrier to entry in your mind. And remember, if you've been not firing in the markets like you want, if you feel like you're missing out, if you feel like you need to kind of get a reboot in some ways, a lot of it starts in our mind, right? We've got to free up our mind to open ourselves to opportunity. We've got to free our mind to say, how little risk can I take? Let's reframe that. How little risk can I take to find out a strategy that can work for me, that I can gain confidence in? And so that's what I'm setting up as my lowest risk offer for you in getting you started here. It's a 3-month offer. But it gives you all the extra educational resources that my longer term subscribers get. So you get the settings and rules sheet. You just have to keep it to yourself. You get the weekly video training. You get the dedicated email to me and my analyst team. If you bought off my website, it'd be $297 each month times 3 months. That'd be 891 bucks you would pay. But Dave and the Festival of Traders folks have been so good to me that I've taken it down by 80%. I've taken it down from 891. Take 700 bucks off of that. Take it down to 177. Try it for 3 months. I really don't like the 1 month trial kind of concept, because I think you need to kind of be able to go through both types of cycles, when it's working and also the times where we have to stop it out. So you see how both sides work. This is reality trading. This is not fantasy trading. And so what we set up for you is a special page. We call it's members.bigtrends.com/festival. Thank you, Dave, for posting that. I'll pop it up here in just a moment, but basically let me also just answer a few of the frequently asked questions. We're just doing simple call and put buying. We're not trying to do any spreads or option selling. We send out real-time email alerts, and you can also get it as a text alert via the WhatsApp technology. Palantir Options Trader, acronym POT, but basically we're not trading POT stocks. We're only trading Palantir. Palantir Options Trader trades are sent by 11 a.m. Eastern at the latest on a given trading day. 5 trading day hold. Once we get our double on half, we'll get about 6 to 8 trades a month. We'll average, we expect, even in the last 12 months with the more recent rise in Palantir, we're still averaging under $2 a contract. So you could get at least 5 contracts to get started. And then you get the bonus gifts of my weekly video training. I do that myself to keep teaching you, keep you learning, keep you green and growing, not ripe and rotting, right? We want to stay fresh. We want to be always picking up new information. Palantir settings and rules, and a dedicated email to reach me and my analyst team. And remember, just one trade alone can easily pay for that 177. We showed you that one at the start where we picked up that was more the reversal pattern, and that one went from 100 and 200% gains respectively on the 2 targets on those 2 rectangles over a week at maximum, right? So the key is putting yourself in a position to be at maximum effectiveness. And of course, remembering that past performance can't guarantee future results, but what we do say is we're going to assure you we're going to continue to follow the system very cleanly, very easily. And so when you go to that special link that we set up for you here, let me just show you that page real quick before I give it back to Dave in about 30 seconds, is to say, look, you know what it can do for you. 3 months, we're taking it with all the bonus resources from 891 to only 177. And we keep our order pages really clean and simple. So members.bigtrends.com/festival, you'll see you got your credit card. You can put it in there or go to PayPal. I love using PayPal. It's the way to go. So either way you go, it's a great special, great way to start. Try it for 3 months. I think you'll not like it, but love it. And we are committed to your success. So call us at our 800 Big Trends number if you got any questions. I'm going to give it back to Dave so you can get on with our next great presenter. Have a great trading day watching all the festival fellow traders. And thank you, Dave, for having me as always.